Okay, let us quickly go on with some remarks on personal tax liability just to get finished with that. So here you see again the basic logic of the testing steps which we have to make in the beginning for personal tax liability, natural person or juridical person, and then limited or unlimited tax liability in each case, depending on which tax act you have to use. Now, one or two topics in addition with that can already be discussed. The first thing is with the natural persons, when does the tax liability begin and when does it end? That requires first that you have a person, and second, that the person fulfills the condition for an unlimited tax liability. So, from which moment on do you have a natural person? Usually that is with your birth, your existence as a natural person begins. So, under civil law, that is usually the starting point of your being a natural person. That is sometimes for the beginner a bit surprising because children can probably not run a business or not earn money. But as a child, you can, for example, already inherit a house from your dead parents or so. And so the rent income would be yours already. And so, indeed, directly after birth, you can already have an income which can be taxable. And so, your parents or somebody else acting for you will have to file to hand in a tax declaration, and that will be worked on by the fiscal office. So, from the beginning of your birth, you can already and you are already a potential taxpayer. That's probably the reason why most of us directly begin to scream after birth. Your liability as a natural person logically ends at the last minute of your life because then you are no longer able to have any rights. So, and the moment of your death, that is at the same point of time the end of your tax liability. Also, that probably explains why many people of their deathbed convey a peaceful impression, because there is also some positive aspect combined with the point of time. Yeah. With juridical persons, we have a similar structure. Their tax liability in principle begin when they begin to exist and it ends when they end to exist. Now, under civil law, that's a strictly formal matter. The existence of a juridical person begins when it's registered in the official register, because from that moment on it exists and not earlier. And on the opposite side of events, a juridical person ends its existence when it's removed from the register. So that is the duration of existence for civil law. The same is valid for tax law, although it is probably possible that shareholders or founders of a juridical person already set up all the statutes and then apply for registration. And even before registration is carried through, they already begin to act in the name of that future juridical person. In such a situation, if a juridical person is treated as already existing by all the persons involved, and later nobody brings forward that this was not yet the case under civil law. So in cases where such a future juridical person is involved in a situation and the parties involved carry it through as if it existed, that will already be ascribed to that future juridical person. The reason is that tax law very often looks not to the formalities but to the economic substance of a situation. The same applies to the other end of the life of a juridical person. If a juridical person is already removed from the register, so its civil law existence has terminated, then nevertheless the tax authorities still have a possibility to treat it as existing and to direct or address tax notices to that juridical person. The background is usually when you terminate the existence of a juridical person, the property of that juridical person will still be in the hands of some liquidators or other people who now have the task to distribute the remaining property among the persons interested in that or who have a right to that. And so the fiscal office just says if that juridical person has been removed from the register, but there is still property, then we can still raise claims to that remaining property because this is the rest what was left behind by the juridical person. So it can be treated as still existing under tax law until all the economic relationships of that former juridical person are terminated or are fulfilled. That just has a practical reason. Imagine there is a juridical person which owes the fiscal authorities some 2 million or so, and shortly before the tax notice comes in, they remove it from the register, and so the tax notice would be directed to a non-existing person and could therefore have no effect any longer. Just to avoid this, there is a fiction that for fiscal purposes a juridical person exists as long as all the relations with the fiscal authorities have been successfully terminated. Okay. Here we have a small addition in between, because here I want to show you that indeed tax law in many cases doesn't stick absolutely to the formalities of civil law, but very often looks to the substance of the economic events. For example, there is a section 40 which says for taxation it plays no role if something that fulfills the conditions of a tax rule partly or in full violates a law or morality or so. So it does not play a role if something was allowed or not allowed. The decisive thing is if you did it. If you did it, it triggered a tax. Section 41, if a transaction is not really valid under civil law, or if under civil law it loses its obligatory character, for example, a contract is regarded as invalid under civil law, that does not matter if in reality the parties involved stick to it. That would be, for example, an idea which resembles the thought which I just brought forward. Juridical person which is not yet fully registered but is treated already as an existing entity by its business partners or by its shareholders, that would be respected also for the tax assessment. 41.2 of the General Tax Code, the AO, would also say transactions which are only made on paper, so sham transactions which are not meant seriously, or sham actions which are not acted, which are not done seriously, but which are only pretended to exist, are disregarded for the application of tax laws. Now the problem is naturally if, for example, you agreed on paper on a sale and later say that was not meant seriously and we didn't carry it through, you will have the burden of proof. So that's still a risk. But if a transaction is only a sham, is only pretended to exist but does not really exist, then it does not exist for tax law. So mere formalities do not count. And if such a sham transaction, something which just masks reality, which is not meant seriously, is used to mask or to hide a true transaction, another one which is really intended, then that other transaction which is economically intended and which is really, if you look to the facts, which is really done, that this other transaction will be regarded as relevant for the application of the tax laws. That even has to do, or even would be valid for things like ownership. Also here we have that thought expressed that it does not matter who has the name of being an owner, but who has the substance of the right of ownership. So we have here a rule which says assets are in principle regarded as belonging to their owners, but if somebody else than the official owner has in fact the possibility to exercise all the rights connected with ownership and can exclude the official owner from any influence for the whole remaining useful life of an asset, under usual circumstances at least, then this person is to be regarded as the owner of that asset for tax law. That is called economic ownership, and also that plays an important role for tax. For example, in cases where you hear about leasing contracts, in a tax context, that always plays a role if you have a case of economic ownership with the person who is the person who takes the asset for rent or not. Okay, good. Just to sum up what we have talked about now concerning personal tax liability, when it comes to beginning and end, when it comes to if a transaction counts or does not count under tax law, then we look to civil law. Yes, okay, but if there are doubts, we look to the economic reality behind that. And now to draw the conclusion, similar ideas govern the existence of a juridical person if it's not yet fully registered. For example, the signature of the judge is still missing, but the statutes exist, the shareholders exist, everything else already exists, and it can already be treated as a tax subject for taxation. And on the other end of its life, that is, when it's removed from the register, a similar idea might play a role. Now, another thing. Beginning and end of unlimited or limited tax liability are not only connected with the existence of the person in itself, but also with the fulfillment of the requirements for unlimited or limited tax liability. So it is possible that you are an unlimited tax liability taxpayer in the beginning of the year because you live here in Germany, and later you move out of Germany and then you don't have any residence or habitual abode here any longer. So from that date on, you no longer fulfill the characteristics of 1.1 ESTG, but only of 1.4 ESTG. So now you will be a limited liability taxpayer. And the interesting thing is, under German law, you are not qualified as unlimited tax liability person for the whole year, but the status changes on the exact date when the conditions are fulfilled or fall away. So imagine you leave Germany on the morning of the 31st of December of a given year one, then everything which you earn until that morning will be covered under unlimited tax liability. What you earn in the evening of the same day is only viewed under the perspective of limited tax liability. So who changes residence in the middle of the year and moves out from Germany or moves in at the moment when you move, on the day, on the minute, your status as a taxpayer changes. Good. Now, does this really lead to differences? And yes, it does. First, as an unlimited tax liability taxpayer, you owe taxes for your worldwide income As a limited one, you only owe the taxes for the inland income. So that's the first big difference. Then special expenses and extraordinary expenses are deductible. You remember that personal special allowances were granted, and that unavoidable extraordinary private expense could also be deducted from the tax base, so that you only have to pay for that income which you really can dispose of freely. That idea is not followed with limited liability taxpayers, because the idea is you shall do this in your home state. And so as many home states, or most home states, will grant you deductibility for these amounts, it's not necessary to grant this option to you if you don't live here. Then with unlimited tax liability, you have a zero bracket zone in the tariff. You have the splitting tariff for married couples. You have progressive tax rates. With the limited tax liability, all that is not automatically guaranteed. There will be usually no zero zone. The idea is this is to be done in your home state. There will be no special assessment for married couples, although that is seen as a responsibility of the state where you live. And the progression will be far lower, because even if the tax rate is progressive, it will only refer to your inland income, so to a far smaller part of your worldwide income, of your total income. So your tax rate will be considerably lower. If you compare these two ways, then you see there are some things which are positive for you in unlimited tax liability. For example, the deductibility of the special and extraordinary expense, and the tax-free character of the basic allowance of the subsistence level amounts which you need to pay, or which you need to spend for survival. That is not granted in limited tax liability. On the other hand, the tax rates for limited liability are most often lower than the rates which you would pay in case of unlimited tax liability. So it can have advantages to be an unlimited tax liability person. It can have advantages to be a limited tax liability one. And naturally, people always look what could be better for me, and sometimes they try to change their status from the one alternative to the other one. So who has only income from Germany and has 10 children to feed, that will be much deductible private amounts. That person will long to be unlimited tax liability payer. On the other hand, who has, for example, big amount of interest income from Germany, will prefer to be a limited tax liability taxpayer, because in the list of Section 49, usual amounts of interest payments are not covered in the list of the taxable income, even if that interest comes from Germany. So there you would have a very good deal, or would be a very good opportunity not to live in Germany. Yeah? So you have some people who prefer the one status than the other one. And the second conclusion is the people will sometimes try to change their tax status from the one tax liability to the other one, just in order to profit from the change, from the better version. And sometimes now Parliament finds that good, or is okay with that, and other situations exist where Parliament does not want this and regards this as an unwanted behavior, which they then want to exclude by special rules. And that is the explanation why we also have some additional variants of personal tax liability, which try to deal with these potential changes between the two extremes of genuine unlimited and genuine limited tax liability. For example, certain people living abroad, having a family, but not having sufficient opportunity to deduct their personal expenses in their home state. These people would have a strong interest in being taxed under the rules of German unlimited tax liability. In certain situations, we give them the option to opt voluntarily for unlimited tax liability for a special form of that. Under section paragraph 1(3) ESTG. It's sometimes called the optional or fictitious unlimited tax liability, where people live abroad but choose to be taxed according to the rules of unlimited tax liability because they are more favorable to them. Not permitted to everybody, will be part of future lectures, but can be really advantageous for those who can apply for this special rule. The other special form of tax liability is an extended limited tax liability that is aimed at those cases where German taxpayers with German citizenship just move their residence abroad only in order to become a limited tax liability payer and profit from reduced rates and a reduced catalog of taxable income. This is, as it is, a rather strange situation and a rather specific situation inserted in a special, very special law on international relations, the Außensteuergesetz, that is the External Relations Tax Act, or sometimes also translated as Foreign Relations Tax Act, the ASTG. And there, German citizens get covered by a harder version of the limited tax liability, which in the final effect renders moving abroad to a tax haven completely senseless, because what you save by lower taxes in the tax oasis, your new home state, is probably outweighed or equalized by a higher tax burden on your German income. Last but not least, there is a curiosity for certain people working in the service of the German state but living abroad. There can also be an unlimited tax liability if somebody is in the public service of the state but lives abroad. That is mostly aimed at diplomats and their family members, because diplomats living abroad can not be taxed on their worldwide income in the country where they, for example, function as an ambassador. And now imagine somebody would be a super rich person. That person would find the job as an ambassador really promising, because if you don't live in Germany, there would be no worldwide income taxability in Germany. And as you are the ambassador in the country where you live, you could not be taxed there with your worldwide income either. And so all the rich people would probably apply for jobs as ambassadors, and that would be a kind of an unfair tax privilege to rich persons. And so that gap was closed by this special rule. Good. Yeah. So optional tax liability 1(3) is something which you should keep in mind, because that affects, or that is possible for the average persons living abroad, usually persons living near the border in the other country and commuting to a workplace within the country. They very often opt for that optional unlimited tax liability in order to be able to deduct their personal expenses from the tax base in Germany. Yeah. The specific conditions which these people have to fulfill can be seen in paragraph 1(3) ESTG, and I'm not going to read that out now, but I recommend to read that out, at home. Okay. Yeah, with some additions in section 1A. So there are some nice details. Okay. And yeah, this is what I have to say to personal tax liability. And now you see the next step will be what is income. So the next step will be the second step of our testing scheme. So to find out if your income from a certain event is taxable income, under which headline or which type of income it has to be classified, which tax base you have to compute for that, and to which year that belongs. That is something which we are going to talk about in the next video, naturally. So I wish you to have a good break until you show up again and view the next video. Thanks for watching for today.